What happens when the Fed's lifeline is gone and the bubble is everywhere? Today, we're on the edge of a crash, but it's not just stocks in trouble. The great crash, the tech crash, the housing crash, now the AI crash. Every asset is inflated. We're watching an everything bubble blow off, and no one's immune. We are living through a paradox, an era of unprecedented market euphoria, where all-time highs are no longer a surprise, but a daily expectation. The relentless drumbeat of optimism, fueled by narratives of technological revolution and endless growth, has convinced a generation of investors that the old rules of financial gravity no longer apply. Headlines in 2024 celebrated the S&P 500 surging past 5,000 for the first time, a milestone that felt less like a peak and more like a new baseline. But this is a dangerous illusion. Beneath the shimmering surface of this seemingly endless bull run, a series of seismic pressures are building. The aftershocks of a global pandemic, the fastest interest rate hiking cycle in 40 years, and simmering geopolitical conflicts are converging. These aren't distant tremors, they are cracks forming in the very foundation of the global financial system. The warning signs aren't just whispering anymore, they are screaming for anyone willing to listen. Let's start with the data, using the single most reliable long-term valuation metric we have, the Shiller Cyclically Adjusted Price-to-Earnings Ratio, or CAPE. It's a brilliant tool because it doesn't look at just 1 year of earnings, which can be volatile. Instead, it averages a full decade of inflation-adjusted earnings to give a true, smoothed-out picture of where stock prices stand relative to their actual profit-generating power. Right now, that metric is sitting near 38. To put that in perspective, its historical average since 1881 is about 17. We have only seen valuations this stretch twice before in modern history. In 1929, when the ratio hit 30 just before the crash that triggered the Great Depression, and at the absolute peak of the dot-com bubble in 1999, when it soared past 44, a level followed by an 80% collapse in the Nasdaq. Both instances led to a devastating lost decade for investors, where stock portfolios went nowhere for 10 years. Today, we are breathing that same thin, treacherous air at a valuation higher than the peak of 1929. For over a decade, these dangerously high stock prices were justified by a simple, powerful acronym, TINA, or There Is No Alternative. With central banks holding interest rates at near zero, savers were punished. A government bond might pay you 1%, while your savings account paid even less. To get any kind of return, you were forced to gamble in the stock market. But TINA is dead. In a desperate battle against soaring inflation, the Federal Reserve slammed on the brakes, hiking rates at a pace not seen since the 1980s. Now, the game has completely changed. With long-term, risk-free government bond yields climbing near 5%, investors are no longer being forced into equities. Why gamble on a volatile stock market priced for perfection when you can get a guaranteed 5% return backed by the full faith and credit of the US government? This fundamental shift acts like a powerful vacuum, draining capital from the stock market. Simultaneously, it puts immense pressure on corporate balance sheets as the era of cheap money and easy debt comes to an abrupt and painful end. And this isn't just a stock market problem. The cheap money era didn't just inflate stock prices, it created what legendary investor Jeremy Grantham calls a super bubble. The everything bubble isn't just fear-mongering, it's a reality we've all witnessed. From real estate prices detaching from local incomes to the speculative manias in cryptocurrencies, NFTs and SPACs, asset classes across the board have been inflated to unsustainable levels. Albert Edwards, the Société Générale strategist who famously foresaw the dot-com bust, has been warning of what he calls the Ice Age thesis for years. He argues that the twin bubbles in housing and equities, inflated by central bank policy, are setting the stage for a long deflationary winter. Deflation, or falling prices, might sound good, but it's an economic poison, crushing corporate profits and making old debts impossible to repay. A trap that led to Japan's infamous lost decades, a period from which its stock market still hasn't fully recovered. Compounding all these risks is an unprecedented level of market concentration. The entire US stock market's performance now hinges on a handful of mega-cap tech stocks, dubbed the Magnificent Seven. In 2023, these 7 companies were responsible for the vast majority of the S&P 500's gains. The other 493 companies were, on average, flat. This creates a dangerous illusion of strength, masking profound weakness in the broader economy. It's a classic market topping signal, reminiscent of the Nifty 50 stocks in the 1970s, which led to a brutal bear market. Today's market is a skyscraper balanced on just 7 pillars. If just one or two of these giants stumble, due to increased competition, regulatory crackdowns, or simply the law of large numbers making growth harder, they won't just fall, they'll pull the entire edifice down with them, creating a domino effect that could dwarf previous crashes. The widespread tech layoffs we saw in 2023 and 2024 could be the first sign that these pillars are beginning to crack. So yes, this time the backdrop is different because it's not just one thing, it's everything, all at once. We have the speculative, bubble-like valuations of 1929, we have the tech-centric narrow market mania of 2000, and we have a global debt structure built for 0% interest rates now facing the violent shock of a new high-rate reality. Valuations, yields, concentration, and debt levels are all flashing bright red. The stage is set for a perfect storm, where a failure in one part of the system could trigger a catastrophic cascade across the entire global economy. The question is no longer a correction is coming, but how severe it will be. To truly understand the magnitude of the danger we face, we must first dissect the anatomy of the crashes that came before, the cataclysms that taught us to fear the downside. Let's compare past crashes. 1929, markets lost nearly 90%, setting off the Great Depression. 1987, Black Monday saw a 23% one-day plunge. 2000, the dot-com collapse snapped NASDAQ, 80% vaporizing many megacaps. 2008, the global financial crisis crushed the S&P by 57%. 2020, the coronavirus crash fell 33%, only to bounce back on aggressive stimulus. But what if this crash has no safety net? We are standing at a familiar yet terrifying precipice. This is what economists call the installation phase of a technological revolution. It's a period defined not by quiet, steady progress, but by a deafening roar of hype, a tidal wave of capital, and a stark, unnerving silence when it comes to actual measurable returns. This isn't just innovation, it's a full-blown gold rush. But today the gold isn't a shiny metal, it's the promise of artificial general intelligence. And the money isn't going to the gold miners, but to the companies selling the picks and shovels, the chip makers, the cloud providers, the data centers. The promise of future fortunes completely eclipses present-day balance sheets. Every major technological shift from the canals of the 18th century to the railways of the 19th to the internet of the late 20th has had a phase exactly like this. A frenzied speculative mania where belief trumps reality. But the scale and speed of the AI boom are utterly unprecedented. The dot-com bubble was inflated over 5 years. The AI bubble has reached a similar fever pitch in less than 18 months. The numbers paint a brutal, undeniable picture of this disconnect. Let's talk about ROI, return on investment. It's a simple concept. For every dollar you put in, how many dollars do you get back? A landmark MIT report reveals a staggering statistic that should send a chill down the spine of every CEO. 95% of corporate AI pilot programs deliver zero ROI. That's not a small return, it's return. For every 100 companies pouring millions, sometimes billions into AI initiatives, 95 are essentially building a bonfire with their cash. The question is, why? The hype suggests AI is a plug-and-play solution. The reality is a nightmare of complexity. Integrating AI isn't like installing new software. It requires a fundamental rewiring of decades-old business processes. It demands access to vast, clean, and properly labeled datasets, a resource most companies simply do not possess. Their data is a messy, siloed disaster. Then there's the talent war. The handful of engineers who can actually build and deploy these systems command salaries that rival professional athletes, creating a brain drain that leaves most companies behind. And finally, the sheer cost of computation is astronomical, consuming energy on the scale of small countries. This is why we see a paradox. Even as companies tout their AI prowess, the tech sector saw massive layoffs throughout 2023 and 2024. They are burning through cash with no profits to show for it, resulting in a digital graveyard of failed projects and innovation theater. Slick presentations that look great in a press release but do absolutely nothing for the bottom line. And the first tremors of this reality check are already shaking the public markets. The darlings of the AI boom, stocks like Nvidia, Palantir, and Meta, rode the wave to stratospheric valuations, reaching price-to-sales ratios that dwarfed even the peaks of the dot-com bubble. For a time it seemed the only direction was up, but now they are showing clear signs of fatigue. Their charts, once a near-vertical rocket launch, now look like a roller coaster cresting its highest, most terrifying peak. This is happening in a macroeconomic environment of stubbornly high inflation and the highest interest rates in over 2 decades. As the Federal Reserve has made clear, the era of free money is over. Higher rates make distant speculative future profits worth much less today. These aren't minor healthy corrections. They are the market's first whispers of profound doubt. It's a signal that the powerful narrative is starting to fray. As a growing chorus of investors begins to ask the forbidden question, can any company, no matter how promising, truly be worth trillions of dollars based on potential alone? This is where the danger escalates exponentially. Legendary investor Ray Dalio has sounded the alarm, warning that this moment feels eerily similar to the dot-com bubble of 2000, the same irrational exuberance, the same growth at any cost mentality, the same dismissal of traditional valuation metrics. But he adds a crucial, chilling caveat. This isn't just a tech bubble, it's an everything bubble. What does that mean? It means the cheap money and speculative fever born from the AI narrative haven't stayed contained within the tech sector. The promise of AI is so profound that its speculative froth has spilled over, infecting every other asset class. Commercial real estate is being valued on the hope that AI will create new efficiencies, ignoring the work-from-home trend. Private equity funds are raising billions for AI-adjacent startups with no products. Even commodities like copper are bid up on the assumption that AI data centers will require endless wiring. The entire global financial system, already burdened by record levels of government and corporate debt, has become leveraged to a single, spectacular, and dangerously unstable idea. This is the classic physics of a financial bubble, a phenomenon driven not by spreadsheets and algorithms, but by the most powerful and predictable market force of all: human psychology. Nobel laureate Robert Shiller calls this narrative economics. A compelling story becomes more infectious than any virus. In this case, the story of all-powerful AI is so good it feels true. The primal fear of missing out, FOMO, overwhelms sober analysis. Your neighbor gets rich on an AI stock and suddenly your own careful financial plan feels foolish. This herd mentality, amplified at light speed by social media, creates a feedback loop. Gigantic capital flows chase the story, not the fundamentals. The hype builds a skyscraper of valuation on a foundation of sand, but foundations of sand always give way. When the narrative finally breaks, when the market pivots from believing the story to demanding the results, the repricing will be swift, violent, and brutal. This won't be a gentle deflation like a leaky tire, it will be a shockwave. Because unlike the dot-com bust, which was largely contained to the tech sector, this time, everything is connected. AI isn't just another industry, it's being woven into the operational fabric of banking, logistics, healthcare, and energy. The bubble isn't just in tech stocks, it's in the bonds that finance them, the real estate that houses them, and the global indices that track them. So what happens when the central pin is pulled from this interconnected structure? What does the crash of the everything bubble actually look like? Let's look at the data. Shiller Cape near 38 implies a 65–70% correction if historical mean reverts. Long-term bonds now yield 4 times more than stock dividends, yet equities stay inflated. Mega-cap firms now make up roughly 37% of the S&P, dwarfing the 20–33% of the tech bust era. Something's got to give. Historic valuation extremes don't last forever. Investors can be slow to change, until they rush at once. Next, what the legends are saying about this moment. Albert Edwards. The Fed can't prop this up forever, both stocks and housing are bubbles. Robert Kiyosaki. The everything bubble may be bigger than 1929. Jeremy Grantham. Markets always revert to the mean. These valuations simply can't stay. Rubini-style outlook. Global debt, demographics, stagflation. It's a perfect storm. Listen to the warnings. The signals are broad and consistent. So what could actually trigger the fall? 1. Bond yields rise, siphoning demand from stocks. 2. Fed towing political lines or missing signals could break confidence. 3. AI disillusionment hits, projects underperform and investors retreat. 4. A geopolitical black swan that ignites panic. 5. A hidden private credit bubble, in pay later, private equity. That goes bust. Any one of these could be the match, or several could strike together. And when they do, the move can be insanely violent. So, with the storm clouds gathering, how do you prepare? The first step isn't to sell everything in a panic, it's to conduct a financial fire drill. This is your personal readiness plan. You must stress test your entire financial life not for a gentle 10% correction but for a true, gut-wrenching, worst-case scenario. Forget a 40% drop in the Nasdaq. What happens if it plummets 75% just like it did in the dot-com bust? What if your largest, most trusted holdings lose half their value in a matter of weeks? This isn't an exercise in fear-mongering, it's a strategic inoculation against the virus of panic. The 2008 crisis was a brutal lesson. When true fear takes hold, everything you thought you knew about diversification breaks down. Correlations go to 1. Everything sells off together. By running these simulations now, in the calm before the storm, you're not just testing your numbers, you're testing your emotional response. You're building the mental and emotional calluses required to stick to a rational plan while the world around you is consumed by fear and forced liquidations. Second, you must surgically dismantle your concentration risk. Right now, the market is dangerously top-heavy, driven by an intense fear of missing out. The so-called Magnificent Seven have become a black hole for capital, sucking in trillions and now accounting for nearly 30% of the entire S&P 500. We've seen this movie before. It was the Nifty 50 in the 1970s, the can't-miss blue chips that got decimated. It was the dot-com darlings in 1999. This is the epicenter of the everything bubble. True diversification isn't just owning 500 stocks through an index fund that's dominated by a few names. It's a deliberate rotation into genuinely defensive sectors, the boring but beautiful businesses that provide essential goods and services regardless of the economic climate. Think utilities providing power, consumer staples selling toothpaste and toilet paper, and healthcare companies providing life-saving treatments. A powerful, almost automatic way to achieve this is through an equal weight ETF. Instead of letting market cap dictate your exposure, it gives every company in the index the same weight. This forces a disciplined rebalancing, selling winners as they become overvalued and buying losers when they are cheap. It's a built-in shock absorber for when today's high flyers inevitably fall from grace. Third, understand that in a crisis, liquidity is not just king, it's the entire kingdom. Cash is your fortress. It's the wall that protects you from becoming a forced seller. A forced seller is someone leveraged to the hilt who gets a margin call and has to liquidate their best assets at the worst possible price, simply to survive. Cash prevents that. It provides the peace of mind to think clearly. But cash is also your most powerful offensive weapon. It is the dry powder that allows you to follow Warren Buffett's most famous advice: be greedy when others are fearful. While others are panic selling their shares in world-class companies, you can be the one on the other side of the trade, buying those same assets at a 50, 60, or even 70% discount. This is not market timing, it's opportunity harvesting. This is precisely how generational wealth is created. And while you wait for that blood-in-the-streets moment, your capital shouldn't be idle. Short-duration U.S. Treasury bills, or T-bills, currently offer attractive yields with virtually zero price volatility. Unlike long-term bonds that got crushed when interest rates rose, T-bills are a stable, secure place to park your war chest, earning a return while you wait for the opportunity of a lifetime. Fourth, you must hedge your paper wealth with real, tangible assets. For over 5,000 years, through the rise and fall of empires, gold has been the ultimate store of value and insurance against systemic chaos. Every fiat currency in history has eventually returned to its intrinsic value, zero. Gold endures. When faith in government promises and printed money inevitably falters, capital doesn't just walk, it flees to the one monetary asset that is no one else's liability. The one asset with zero counterparty risk, physical gold. And I must be clear, we are not talking about paper proxies like ETFs. We are talking about tangible bullion, coins or bars that you can hold in your hand. In a true crisis, a paper claim is only as good as the institution that backs it. Physical gold is its own backing. It's no coincidence that central banks around the world have been buying gold at a record pace. They see the writing on the wall. Platinum offers a similar safe haven quality, with the added tailwind of critical industrial demand in sectors like automotive and green energy. A modest 5 to 10% allocation isn't about speculation, it's about wealth preservation. It's fire insurance for your portfolio when the world of paper assets is burning down. Fifth, you must transform from a passive investor into a vigilant student of the macro environment. This means being proactive, not reactive. You must watch key data and events like a military strategist. When the Federal Reserve speaks, don't just hear the headlines, listen between the lines for shifts in tone. When the monthly CPI report is released, don't just look at the headline number, dig into the components. Is supercore services inflation, the Fed's preferred metric, remaining stubbornly high? That's a critical signal. You must also watch the credit markets, the plumbing of the financial system. Is the spread between high-yield junk bonds and safe treasuries widening? That's the canary in the coal mine, signaling rising fear. And keep your eyes on the global map. A conflict in the Strait of Hormuz, a blockade in the Taiwan Strait. These aren't distant news stories. They are potential catalysts that can instantly reprice global energy and supply chains, igniting the fuse on the everything bubble. Your job is to connect these dots before the rest of the market wakes up. Finally, you must internalize the most terrifying truth of our time. The Federal Reserve is trapped. This marks the end of an era. For the last 4 decades, they had a simple playbook for every crisis: print trillions of dollars and slash interest rates to zero. That safety net, the famous Fed put, is gone. Today, they face an impossible choice. If they cut rates to rescue falling asset prices, they risk reigniting the very inflation they just fought so hard to contain, destroying the wealth of savers and workers. But if they keep rates high to fight inflation, the crushing weight of a $34 trillion national debt becomes mathematically unsustainable. The interest payments alone are projected to soon become the largest single item in the federal budget. This is a concept economists call fiscal dominance, where the central bank is no longer independent, but a prisoner of the government's debt. They are out of ammo. There is no easy rescue coming. There is no cavalry. When the market finally realizes the Fed cannot save it, the repricing will be violent and swift. The fall will not be gradual. The time for passive hope, for closing your eyes and wishing for the best, is definitively over. Now is the time for clear-eyed, decisive action. Navigating the storm that is coming requires more than just a few tips. It requires a comprehensive, dynamic strategy. That's why I created this channel, the Everything Bubble Crash Prep. This isn't just a series of videos, it's your strategic briefing room. It's where we provide the detailed analysis and actionable steps you need to not only protect your capital, but to position yourself to seize the historic opportunities that will emerge from the chaos. The window to build your arc is closing with each passing day. Subscribe now and hit the notification bell because our work is just beginning. In our upcoming videos, we will deep dive into specific assets that thrive in stagflation and expose the hidden risks in the corporate bond market. Don't be a victim of the coming crash, become a student of it. Your financial future depends on the actions you take today.